Let's kick off. So this presentation is entitled, Was That It? Because really quite simply, if you remember the last time we were speaking to you, we were talking about offshore investments and we were talking about maybe the confusion that was coming and we wouldn't bet against Trump and who knows what was going to happen. And then Liberation Day happened. I'm sure you all know what Liberation Day, that was the 2nd of April when Trump unleashed his chaos on the world. It also coincided with our GNU going through some ructions on that particular day. And as you will see, the left-hand chart just really shows what markets have done this year. So you can see that markets started off reasonably well, and then April hit and everything collapsed. And yet look at where we are now. So this was updated this morning, and we sit in a position today where all markets are positive for the year. And if you actually look very closely at that chart, the South African market is at the top of that whole pile. So can you believe that? So, but you've got to appreciate some cartoonists around the world. Matt writes cartoons for the Daily Telegraph in the UK, and he's a wonderful source of inspiration. But I'm sure you've all seen that photo where Trump is reading a book called The Art of the Deal, and his Chinese counterpart is reading a book called The Art of War, and now we have a new book called The Art of the Hasty U-Turn. And I was just saying this morning that about 3 weeks ago, maybe a month ago now, Goldman Sachs coined a new term in financial markets, the taco trade. And I'm sure you all know what a taco is. It's like a lovely little Mexican food. But the taco trade stands for Trump always chickens out. And that's true. Unfortunately, Trump has heard of this and he's not very impressed with it. He's taken the umph at that. He doesn't like being ridiculed, but he's his own worst enemy. Anyway, the point of the presentation tonight is really to say we've had Liberation Day, we've had a huge amount of volatility in markets over the last couple of months. Markets are back at all-time highs. Was that it? Can we just relax for the rest of the year? Can we just continue, get another glass of wine, and we'll see you all in January? Let's talk about that. Really, I think that the whole point tonight is to sort of demonstrate how quickly things are changing overseas and actually in this country too. And so if you just look at where tariffs are, tariffs really started the year almost at zero, as we know, and then obviously they've been ratcheted up. So the blue line is tariffs overall, imports into the US, and the red line is excluding China. So you can see that the tariffs on China are more severe than on the rest of the world. Now, these lines are actually changing almost day by day. And even in the last 2 weeks, we've had the courts in the US ruling that the tariffs are illegal, then the appeal court reinstating the tariffs. There was obviously, there's been talks between the US and China in London this week. They came to a conclusion yesterday. It appears that the tariffs of 40% that are imposed on China are going to remain. There's no change there. Everybody was hoping that everybody would step back from the brink. But it doesn't appear that has been the case. And so it is one thing for us to sit here dealing with financial markets and the volatility in markets, but if you're actually a businessman in America or elsewhere for that matter, really on a day-to-day basis at the moment, you have no idea where you stand. Because no one really knows what's going to happen on the 9th of July when that 90-day grace period. So he imposed tariffs on the 2nd of April. By the 9th of April, it was the art of the hasty U-turn. He realized that he was possibly making a mistake, and he waived those tariffs for 90 days. That deadline comes up on the 9th of July. No one knows what's going to happen after the 9th of July, whether the tariffs are going to be reimposed, whether there's going to be another postponement, whether some countries are going to get worse hit than others. And as I said before, Trump has chickened out, but actually one thing I wouldn't bet against is the fact that when Trump's in the corner or when he's being ridiculed, he lashes out, because I think that's the nature of the personality. So you can just see how uncertain things are, and these things are changing all the time, and I'm sure by tomorrow or on Monday or next week there will be additional headlines on tariffs that we don't even know about yet. So how can we make decisions in that environment? And you can just see how this really plays out in real time. This is the number of ships that leaves China every day going to America. So it's actually amazing what data you can find out if you go and really dig for it. So You can just see before tariffs were implemented, the number of ships rose very quickly because everybody was trying to get as much stuff to the US as possible before the tariffs kicked in. Then it plummeted. Now that there's been a little bit of respite, the number of ships is rising again. So even just take a moment to ponder that yesterday 60 ships left China for the US. Just think how many goods, how many containers are on all those ships, and how much trade actually goes on. And just think about that for a moment. So just think, yeah. Then I want to sort of focus on what's really also happening in sort of GDP statistics, because this is what we look at when we try and make decisions. So I just want to focus on these bottom two lines. This is a chart by JP Morgan, and this is their forecast, their sort of, I suppose, evolving forecast for GDP growth. And the red line is for quarter two, that's the quarter we're in at the moment, and the green dotted line is for quarter three. Now, you don't expect GDP forecast to change every day. You know, you make a sort of forecast that's generally quite, it's obviously got a few different moving parts, but it doesn't move around. But just look at how those forecasts are moving around and how quickly they're moving around. So again, this is the framework, this is the backdrop against which you are trying to make decisions at the moment. And it's exactly the same on the right-hand side with interest rates. Interest rates are a key variable in financial markets, and interest rate expectations are changing all the time. So on the one hand, you've got President Trump, calling the Federal Reserve incompetent, and they don't know what they're doing, and they should be cutting rates. You've got inflation potentially rising because of tariffs, and the Federal Reserve is saying we need to be a bit cautious, we're not cutting rates. Trump is saying, why aren't you cutting rates? And interest rate expectations are moving around. But interest rates are a key variable in how we value shares and how we value investments. So when things are moving around this quickly, it kind of makes a mockery of trying to put any sense to really what's going on. Because every day, if you input new variables, you're going to get a different answer. So how do you cope with that? Well, before I deal with that question, I want to say that at the same time that we've got all this uncertainty in the short term about where tariffs are going, is the US going into recession, what's going to happen, you've got a much bigger trend at play as well. And that is this concept of US exceptionalism. So really, if we think about it, the US has been has been the global superpower and hegemon really since the end of the Second World War. And a lot of the institutions that we have today were established after World War II and were driven by the US, the United Nations, the World Bank, even the World Health Organization. All those kind of bodies were really set up and administered and driven by the US. And then when the Soviet Union collapsed in the late 1980s, the US really became the only superpower. In addition to that, I suppose since the great financial crisis in 2008, US markets have really outperformed all other markets. So it's really been a case of the US is the only game in town, and I'm sure you've probably listened to other people saying, if you don't have all your money in America, you're crazy. It really has been a very powerful story, and it's been 15 years of continual outperformance. And America's been a strong economy, it's been growing, there's been innovation, there's been obviously the Magnificent Seven, there's been lots of technological advancement over that era. It's been very positive. But all that is being questioned very rapidly at the moment. And you can just see the US budget deficit. So this is an annual thing, and this is how, obviously tax revenue, what they spend less what tax revenue they get. And you can just see how it's deteriorating over time. So we think that our government is very poor at spending and budgeting. The US government is just as bad. And the only reason why they continue to do what they do is because they've got a big economy and the reserve currency, and they have a strong dollar, and all the sins are forgiven. But actually, underneath the surface, things are not going particularly well in the US. And then Trump is trying to pass his big, beautiful bill at the moment. I'm sure you've seen that. It was the little bromance between Musk and Trump was all about last week. But this big, beautiful bill is going to add another $2.5 trillion to the US debt. So America has $37 trillion of debt. Interestingly enough, actually today, it'll happen later on tonight, America has to refinance $22 billion of debt today. So of that $37 billion, 25% is expiring this year. So all the debt that was issued in this kind of period between 2010 and 2022, or a lot of it, is expiring, and typically you just have to roll that over. So you issue new debt and you just repay the existing debt. The problem was that debt was all issued at interest rates that were very low, and now you're issuing the new debt at a much higher interest rate. And so tonight, when the US government tries to issue $22 billion of new debt, it'll be very interesting to see the appetite that investors have for that debt, because investors are certainly questioning whether they want to hold as much US debt in the future as they have done in the past. So you can just see on the chart on the left, this is interest payments as a percent of GDP, and it's been very stable, 3%, and suddenly interest payments are soaring in America. So we're very familiar with this. We often measure our interest payments in South Africa as a percent of tax revenue, and we sit at 21%. So 21% of all our tax revenue just goes on paying interest on our debt. So when I saw this statistic, I went back and I did some calculations to calculate what our interest payments are as a percent of GDP, and we sit at about 5.25%. So only really 1% higher than where the US is sitting. So just let that sink in. And you know what trouble we're in. So no economy is immune. And you might hear, if you read the newspaper or you look at financial magazines, you will probably come across a term called bond vigilantes. And these are bond traders around the world that are looking for opportunities, and they are increasingly questioning whether the US is a safe destination for investment. And the consequence, really the consequence of that is that the US has always been safe, but now you have a president who is unpredictable, you have policy that's unpredictable, you have interest rates that are rising, you have debt that's soaring, and having had 15 years where the US has just been really the best investment in town, everybody around the world is just trying to say, sure, is that really going to be like that in the future? And we had this, I think there's a very big global shift going on away from US assets into other assets, and it has consequences. So the first consequence is that interest rates in America are rising. That's not a good thing, because as I think I've said to everybody before, the US is the foundation stone upon which all other interest rates in the world are essentially referenced against. So if US interest rates are rising, it actually pushes up interest rates around the world, unfortunately. The other consequence is a weaker dollar, and the dollar's been very strong. And as you all know, the currency is just a seesaw. If you have a strong currency on the one side, the other currency must be very weak. So a weak dollar is actually a good thing, and I'll get onto that a little bit later. But that's actually a positive, especially for countries like us. But if you have a weak dollar in the US, it also then starts to question the returns that people are getting on their American investments. So where does that leave us? How many question marks can you count on that slide? There's a lot. I can't even count how many there are. But I think basically the point is that it leaves us with a lot more questions than answers. And that's a problem. Okay, so let's just leave the global situation aside for a moment, and let's go on to what's happening down here in our little corner of paradise. So last year, after the GNU, the election was in May. It took really the whole of June to form the Government of National Unity. And in July, we wrote in one of our Intuition newsletters that we thought that you should follow 7 different statistics to see whether the GNU was getting any progress. What could we follow to gauge whether the GNU was having any success, or whether things in this country were changing, or whether we were getting some momentum after the 10 lost years that we've had? And we chose 7 statistics, 3 of which I have repeated here now. And the first one is confidence. Confidence is the bedrock of everything. If people are confident, you're going to make different decisions than if you're not confident. You're going to buy cars, you're going to buy houses, you're going to take on some debt, you're going to make different decisions. If you're not confident, if you're nervous, if you're worried about getting retrenched or anything, you are going to behave very differently. So it's very encouraging to see that, generally speaking, confidence is improving. You can see business confidence. There's 2 different companies that measure business confidence, and you can see both of those are rising. There has been a little bit of a dip in the last month or 6 weeks, and that is really a reflection of all the budget toing and froing that we've had in this country, and also I think a little bit of what Trump's doing and where tariffs are going to settle, and whether Ramaphosa was going to come out of the White House alive when he went for his meeting, and all those kind of concerns. I mean, it's valid concerns. We were all terrified for Cyril. But I think, generally speaking, you can say that business confidence is improving, and that's obviously very encouraging. But if you look at the other 2, demand for credit, are people borrowing more money? Not really. Yes, there's an uptick in the light blue line, but it's not convincing. So this is obviously year-on-year growth. So people are borrowing money and credit is growing, but the momentum is not improving. It's not as if credit's growing at a faster rate every month. So that's a little bit disappointing. And then on the right-hand side, you've got manufacturing, and anything below 50, any number below 50 is negative, and any number above 50 is positive. And you can just see generally, if you look at the dark blue line, it's well below 50, and the light blue line is significantly below 50. And so, again, if we're looking for examples of, is this country starting to improve? Are we starting to get some momentum? The unfortunate answer is no, not really. And that's not what we expected this time last year. However, I can't always be doom and gloom, because otherwise you don't come back the next time. But there are some green shoots, and the one green shoot is the rand price of oil. So as I said, one of the positives for us is that the dollar is actually starting to weaken. It's been very, very strong for a very long time, and as a consequence, a currency like the rand has been under pressure. But the dollar is starting to weaken. The rand has strengthened. It's sort of 17.70 or 17.80 at the moment. Remember, we almost touched 20 rand to the dollar on that 2nd, 3rd of April when everything was collapsing. So we have strengthened quite a lot. But the other thing that Trump's doing is that he wants a lower oil price, because he doesn't want inflation to get out of control, because that then obviously exacerbates the tariff impact, and then he gets blamed for a poor economy, and that's the last thing that he wants. So he's putting a lot of pressure on the Saudis and on American oil companies to pump oil, and the oil price has dropped quite significantly. So you can just see the rand price of oil is coming down. If I drew a chart of the petrol price, it would also be coming down. I'm sure it probably doesn't feel like it at the pumps, but I can promise you that petrol's lower than it was a couple of years ago. And we can see that starting to come through in the economy. Also, the interest rates are coming down. I was just saying this morning that I got very excited. Actually, the announcement on interest rates was 2 weeks ago now. I got very excited. I was sitting at my desk watching the screens, as you would expect me to be doing. And I saw the headlines pop up, the Reserve Bank cuts interest rates by 50 basis points. And for a long time, we've been saying that the Reserve Bank is too cautious. They are too conservative. It's not a bad thing to be conservative, but sometimes you have to take the bull by the horns and actually be a little bit more decisive and try and get this economy going. And inflation's 2.8%, 3%. There is room for the Reserve Bank to be a little bit more aggressive at the moment. Anyway, I saw the headline pop up. I got super excited. I ran through to Willie. I said, they've cut by 50 basis points. And then 2 minutes later, the corrections popped up. They've only cut by 25 basis points. And my bubble was firmly deflated. But unfortunately, so we do think that interest rates are going to fall a little bit further, probably another 0.25%, maybe 0.5%. But I say the Reserve Bank is always going to err on the conservative side. But the consequence of these, the previous chart and this chart, is really all summarized in this end chart, and that our GDP growth is just getting revised downwards. So if you just look at our GDP growth, and these are different points in time, for 2025, when we stood here this time in December and did our outlook for 2025, we expected our economy to grow at 1.7% this year. That's not great, but it's a lot better than the 0.6% last year. Now we're looking at a growth rate of probably 1.2% for this year, and we're probably going to be lucky if we even get to that. Billy has his doubts whether we'll get over 1%. Equally frustrating, or I suppose disheartening maybe is the right word, is that the forecasts for 2026 are now at 1.4%. We should be at well over 2%. And that's where the frustration, or maybe the opportunity cost comes in, is that, yes, we are moving in the right direction, but if you watch the snail on your garden path tomorrow, he's probably moving faster than we're moving in our economy, unfortunately. So where does that leave us? Right back at square one, unfortunately. And you can count the question marks again. So this is a very tricky time, because really, basically what we're saying is that there are a huge amount of moving parts at the moment. It's very difficult to make any sensible predictions, because we don't know what's going to happen next week with the US or Trump any as much as you do. We can make some educated guesses, but sometimes that's not good enough. So how do we really position your portfolios in a time like this, where the visibility ahead is actually so poor and anything can happen? And I'm going to give you a little economics lesson 101 here for 3 minutes, if you will indulge me. So Basically, there's a concept in investments, sorry, probably not economics, let me give you an investment lesson, called economic profit. And economic profit basically says, well, let me give you an example. Let's say you had R1 million and you invested in the bank. That money would earn some interest, let's say 7%, and that would be very fine. That's the return on your investment, and you know what you're getting. If you decide to take that money out of the bank and start a business with that money, if you're not earning more than 7%, then you've actually destroyed value. You would be better off to have left the money in the bank and to have just done nothing and to spend your time twiddling your thumbs and tending to your garden. But if you've decided to start a business, you then have to really be earning more than 7%, because otherwise you have destroyed value. So economic profit is really that concept of saying how much profit, how much return does a company make, subtract the cost of its capital, whatever, and capital is obviously the combination of its equity capital and its debt, and then what is left over. And if that number is positive, then the company has a reason for being. If it's negative, the directors should ask themselves the question of why it's negative. Now you can see I've chosen Visa here. I'm sure everybody uses their Visa card every day. I know the lady in the front does, because that's my wife, and she uses ours often. Sorry, darling. But Visa is a wonderful company, and it's a poster child for this exact concept, because not only does Visa earn a positive economic profit, you can see that this line is always above zero. But when Visa makes profits, they pay out some of it to their shareholders, but the profit that they keep in the business and they reinvest into the business, every time they do that, they make more and more, they get a higher and higher return on that profit. So that line is rising all the time. So Visa is the classic example of a company where the snowball's just rolling down the hill and getting bigger and bigger all the time. And they have this wonderful global processing network that processes all your transactions all the time, every day, never goes down, and so the wheel continues. But when you make positive economic profit and you make positive returns, that generally translates into very strong cash flows. The company is very cash flow positive, it makes a lot of cash, and then when you make a lot of cash, then you can pay lovely dividends to your shareholders. And if you look at Visa, the dividend, sort of a rolling 12-month dividend, has gone from 60 cents 8 years ago to $2.40 now. So a threefold increase in their dividend over the last 8 years, 300% increase. And that's because of the base that they've created. So we focus very heavily on this chart on the right, and we want to see companies that are demonstrating that. But in order to get to that, you have to do these two things. So now I know what you're going to say to me. So, oh, Michael, you know, anybody can go around and hunt around the world for a company, and you can choose an example, and that's very nice. And Visa is a great company, but it's a global company. It operates in America, and they don't have any of the problems that we have in South Africa. So I've got a South African example for you too. And I could have chosen Clicks. I could have chosen Capitec, which the charts would have been like Visa, but I thought that was too easy. Let me choose another little company that actually gives a little bit of food for thought. So if I make it too easy, then you're going to question my bona fides. So Hudayco is a company that we use quite often. And what's nice about a little company like Hudayco is it's a very South African company. What they do is they supply a lot of parts and machinery and spare parts and bits and pieces for the manufacturing industry and for the mining industry. So if you are replacing equipment on the mines or you're replacing equipment in your factories, generally you're getting stuff from Hudayco, ball bearings, nuts, screws, you name it, all that kind of stuff. And they also do things for consumers, security products, Kodak gas is one of their products, and other bits and pieces like that. So generally you can see that even though we've had no economic growth in this country really for the last 10 years, Hudayco has made an economic profit most of the time. There were 2 times when it hasn't. And so for us, as investment managers, we now go and say, okay, what are those 2 times? What happened in those 2 years to cause that? And the first one here was when SARS hit them with a 400 million rand tax bill that they weren't expecting, and they had to fight that with SARS. And the second one was COVID, and I think we can all probably appreciate that our economy was hit significantly harder by COVID than the US or some of the global economies. We weren't posting checks to everybody like the US was, and you open your postbox in America and there was a $5,000 check waiting for you. But despite Hudayco operating in this country where manufacturing's been under pressure, mining's been under pressure for as long as we can remember it, Hudayco still makes very positive free cash flows, and those cash flows get bigger and bigger over time. And so too has their dividend. And so this is really what we mean by a time for quality. It's companies that have the ability to operate profitably in the bad times if things get a little bit tougher. But if the economy does get better, then they're going to shoot the lights out. They might not do as well as a marginal company, but you're not going to get the nasty surprise on the downside if the economy doesn't perform as we expect it to do. Now, I just want to give you one more example. That's Standard Bank. So please, I said this morning, please don't tell me that you're a customer of Standard Bank and they're a terrible bank, and every time you go into the branch, you wish you could shoot them. Because, as I said to everybody, it's much better to be a shareholder of a bank than a customer of a bank. Shareholders get looked after, customers don't. It's the parody of banking. Right. But Standard Bank over the last 10 years has got more and more competitive. Their cost-to-income ratio has come down and down, so they've become more and more efficient. Partly this because of the way they've obviously made changes in this country, obviously online banking and reducing their branch network and making all those necessary changes. But they have also expanded over the last 25 years into Africa. And that might raise a red flag, and you can say, oh, anybody shouldn't be going anywhere near Africa. Look at NTN, look at Vodacom, look at other companies that have gone into Africa and absolutely regretted it ever since. The difference with Standard Bank is that they probably operate in 25 different African countries, and each of those countries is only 2 to 3% of their profits. So no one country is absolutely critical to their future. So for MTN, if something happens in Nigeria, it's pretty critical to their whole company. But for Standard Bank, because they have such a wide portfolio of businesses, it really you get that positive benefit where the risk is spread across a number of geographies, and yet the profits are much higher than they are in South Africa. And so Standard Bank's done really well. As a consequence of them doing well and on this journey, they have just recently announced that they are intending they're raising their targets, and they intend to get a return on equity of between 18 and 22%. Now you can see that as they become more efficient, their returns are rising. You can see what's happened to the dividend. In this period here was when COVID, and the Reserve Bank explicitly said to the banks, you're not allowed to pay dividends because no one was quite sure exactly what was going to happen. But the way you value banks is essentially on a price-to-book ratio. And the higher your ROE, the higher your price-to-book ratio. There's a very clear correlation between that. FirstRand has always been a much more superior bank to Standard Bank. It's been a more efficient bank, and it's traded at a higher multiple. But you can just see as Standard Bank closes the gap, that share price and that rating is closing the gap too. And so we feel, again, if we're focusing on quality, what we don't want to do is have really any surprises. And if we're focusing on quality, we're very comfortable that Standard Bank is moving in the right direction. It's got a little bit of upside because as it closes the gap, its shares are going to become more valuable. But we're confident that that the chance of a nasty surprise is also relatively low. And that's, I think, what you want in this time. So just to sum it all together, how do we distill it into our portfolios? Beforehand, I've had a chart where it's had sort of 5 different blocks, blue blocks, and I've sort of posted all the different themes. I've just really shifted that around this time. So please, if you see a company in your portfolio that's not on this list, don't give me a phone call tomorrow. This is just a representative sample, and I couldn't fit everything in. But you have a core group of companies in this country that are just experts. They do things well. They're great companies. They deliver the goods time after time, in the good times and the bad times. You want those companies in your portfolios. I'll use ShopRite as an example. We could have Spar. You could have Pick n Pay, you can have ShopRite. Those are the 3 big food retailers, and you can have a choice between them. But there is risk with Spar and there's risk with Pick n Pay. They're both in turnaround situations, and they might come right, and the share price might do 50%, but there's a good chance that they don't come right, and the share price goes down 30%. In this type of environment, we don't want to take that risk. We'd much rather have ShopRite, where we have every confidence that it's going to keep on churning out the growth and churning out the profits. And yes, if things go right in this country, Pick n Pay share price might do better. But if things don't go right, ShopRite's going to be the winner. And we'd rather have a little bit less upside. If things go right, ShopRite will do well. It might not do as well as Pick n Pay, but we're still going to get rewarded for that. So choose your investments carefully. So we always have these themes. The supported consumer. You've heard us talk before about all the social grants in this country. 28 million people get social grants every month. All that money flows around townships. There's a very vibrant township economy in this country, and Some of the companies up there tap into that and are beneficiaries of all the money at the bottom end of the economy. We still believe in the infrastructure and the reform that's going on. It might seem a bit frustrating, but I can tell you that Transnet's getting better and better every month. It is off a very low base, so we can't get too excited, but it is positive that at least every single month Transnet's getting better. They're railing more stuff, they're improving lines, they're rehabilitating railway lines. And so, yes, there's a long way to go. It's not where it needs to be, but at least from our point of view, we can see that the direction of travel is in a positive direction, and that we're not still going down the mine shaft with Transnet. Financial inclusion is another theme, some great companies there. Digitalization will always be a theme probably for the next 20 years. And then you want some commodities in your portfolio to hedge against what's happening in the US. Obviously, if you have a weaker dollar, it's generally quite supportive for commodity prices. What's happening in the US with the shift in global power is very good for gold. And you want one or two of those things there just to be represented. And then we do exactly the same on the offshore side. So again, it's the sort of core side. There's some great companies overseas that just churn out the profits year after year after year, and they're in growth industries that are long-term beneficiaries. And then all the themes, you have some great companies overseas, just great big cash flow champions, Coca-Cola, Mondelez. Mondelez makes Cadbury's and Oreo biscuits and things like that. I'm a fan of their products. But I'm sure, I hope many of you are. If you're not, then go and buy some and push the share price up. But companies like Unilever, Inditex, tobacco, and all those kind of things, just big companies that just churn out the profits regardless of what's going on day to day. Healthcare and wellness. Eli Lilly and Novo Nordisk are the leaders in weight loss drugs around the world and diabetes treatment. Essilor Luxottica is the leader in eyewear, not just sunglasses and all the nice stuff that you wear on the beach, but also obviously all the day-to-day glasses that older people like me need. And obviously, again, I think younger generations are much more focused on their health than maybe slightly older generations are. And Nike and Adidas and companies like that are well placed to benefit from that trend. We've talked about digitalization last time and AI and data centers. We talked about infrastructure and energy last time. And we also talked about China starting to recover and come in from the cold. So that's really what I wanted to say tonight. I promised you it wasn't a particularly long presentation. But maybe the parting comment I want to leave you with is that I think over the next 6 months, you need to expect that you're going to see a lot of headlines. I was away on holiday on the Liberation Day, the 2nd of April. I was sitting in Mountain Zebra National Park, and I saw all this chaos unfolding, and I think, oh, really? And I'm away, I'm not at my desk. And actually, then we went out for a game drive, and it was the best thing ever, because actually one of the worst things that you can do in times like this is to look at headlines and to panic and to make rash decisions. If you'd made a rash decision on that day or the day or two following that, and markets are now back at record highs, you would be seriously regretting it. So I think my parting comment is none of us really know what's going to happen over the next 6 months, but expect the unexpected, but don't necessarily react to it, because remember the taco trade, and Trump always chickens out. Don't say that a headline today is necessarily what's going to happen tomorrow, because things are changing very quickly. So instead of trying to change your whole investment strategy and turning it on its head, rather let us invest in quality companies that can ride out that volatility and still do well regardless. And then when things do settle down, as they always do, then we'll be well placed to do that. So that's really my closing comment. Thank you very much. So as always, I'm very happy to answer any questions, but there's snacks and drinks waiting. So we're also around if you want to just chat to us one-on-one. Yes. Yes. Our insurance is actually, funny enough, one of the most profitable short-term insurers in the whole world. Can you believe it? It's got an exceptionally profitable business model. It's got very low costs. It has a superior underwriting performance. I mean, their underwriting is better than others in terms of the premiums they charge for the risk that they take. And yeah, as a result of that, they're one of the most profitable. So they expanded into Australia probably about, I don't know, really helped me 10 years ago now. maybe, and that's become increasingly more profitable for them. And at the moment, they're expanding into Ireland, which is another very similar market to ourselves. And so, yes, Outsurance is just a great company. It's one of those, it's an example of a company that maybe started a little bit later, had the benefit of a fresh technology platform that they could build on. It's competitive, it's got low costs, it earns a very high return on its capital, and consequently, the share price rewards you accordingly. So yes, it is annoying when you have all the adverts, I agree with you, but they actually deliver the goods. Again, you want to be a shareholder of Outsurance. I thought you were going to say every time you turn on the TV there's tennis, but it is Outsurance. You're quite right. Right, well, thank you very much, everybody. Please stay and join us for some snacks and some drinks. Don't rush away. The team's here, and we'd love to catch up with you. But thank you for coming out on a cold night, and we'll see you in a couple of months' time.